Hey everybody, this is Eric Burkholder here with Jordan Bradford, and we're back to give you all another economic market update since a lot of things have happened, even since our last market update. And so we just want to touch base, kind of give you guys some information and kind of our thoughts moving forward. So, Jordan, why don't you kick us off, kind of tell us the few big data numbers that came out and kind of how the market's responding?
Yeah. Well, it's been a big couple weeks for both market and economic updates here. I know we spoke in our last video a little bit about the Fed raising rates and GDP numbers coming out. Just to reiterate, the Fed did raise rates again at the end of July by another 75 basis points. So that's 2 months in a row we've increased rates by that amount. So the Fed's aggressively raising rates here to attempt to kind of combat inflation. But there are some additional numbers out now. So we got GDP numbers at the end of last week, and I don't think it was a huge surprise, but GDP was down a little bit. So we saw a contraction by about 0.9%. So for comparison purposes, the Q1 GDP contracted by 1.6. So, not as bad as Q1. And there will be additional estimates that come out over the next couple of months. But, 0.9, that's 2 consecutive quarters of negative GDP.
Which historically has been considered a recession. A lot of debate in the news right now whether that actually is a recession or not. I think we're going to stick to the traditional definition and say that that's a recession. But a lot of interesting underlying numbers there as well, which, the employment numbers just came out this week. So, and a big, not miss, but a big hit. Wait, what am I trying to say?
So instead of, having, jobs be lower than expected, they were actually significantly better. We added a lot of jobs.
Surprise.
Yes, a great surprise. Yes. And as you mentioned, right, I think we would agree that, technically we're probably in a recession right now. However, not every recession is created equal. And I think this is a very unique one to the extent that, in the month of July, the U.S. economy added 528,000 jobs, and I believe the estimate was around 250,000. So that's pretty big news that the economy grew by twice or jobs grew by twice as much as what was expected for the month of July. So that's a good sign. That means that companies are hiring. People are finding work. Unemployment's now at the lowest level that it's been since 2020, before the pandemic started. We actually have a net jobs gain. If you look back to February of 2020, pre-pandemic, to now, we actually have gained jobs overall.
Yeah, which is remarkable.
Yeah.
There's some other silver linings in there. I think gas prices or oil prices are now back below at least pre-Ukraine invasion levels. So you're seeing that translate to some relief at the pump. And so, there's some mixed signals in there, but, I think there's a lot of, green shoots, if you will, of some positive things coming out of it. I think a month ago, a lot of people anticipated going into a recession. We anticipated some bad economic numbers. And if you were an investor, knowing we were most likely going to see confirmation of a recession, should we have gotten out of the market? Would that have been a good call?
In hindsight, it doesn't look like that, but I think that that's kind of the sentiment that happens in the market is we see bad news or we expect bad news on the horizon, and our heart says one thing and our brains are telling us something else.
Yeah. So what would that have cost them if they would have gotten out a month ago, knowing we were having all this bad news in front of us?
Yeah, great question. And one that, a lot of clients have talked to us about is just, where the market's at, where it's moving. And, as we talked about in our last video, and we're going to continue to discuss, the first half of the year was not great. Market was down about 20% roughly. That's the S&P 500. But in July, the S&P had its best month since November of 2020. It was up 9.1%. which is putting the S&P 500 at the time of us filming this video here down about 13% year to date. So we're definitely seeing a bit of a bounce back. Now we don't know if that's just short term or if we're in a full recovery or not, of course. But it just goes to show you that even when the news looks bad, expectations may be low. That's oftentimes when some of the best performance in the market happens. When market sentiment gets low, a lot of times, we that's where we start to see some rebounds. Mm-hmm. It's kind of like an inverse of your emotions, really.
Right. Yeah. It's a difficult thing to be an investor and control your emotions. I think mm-hmm. the famous quote is, it may be Warren Buffett, I may be misattributing it, but to be greedy when others are fearful and fearful when others are greedy. And so a month ago, there was a lot of fear, felt really bad, and obviously in hindsight now would have been a really good time to rebalance or put cash to work. And so we're not trying to predict what's going to happen, but just understand that markets can behave the opposite of what you'd expect when you least expect it. And so mm-hmm. having a solid plan that keeps you invested in your risk profile is extremely important. Because imagine if you missed the last month. I mean, instead of being down 13, you're down 21, mm-hmm. right? And that hurts a lot. That's a big mistake. So
right, and you still have to recover that. You got to get that 9% back somewhere. So when does that happen, right? If you miss out on that, you're not getting that extra return likely until the market's already recovered.
Right, exactly. So we talked a couple weeks ago and did a kind of a mid-year update, but I think as we said, I mean, there's some mixed news coming out. It seems like we're kind of still getting some mixed news, but I mean, overall, I would say glass is half full in my opinion, and hopefully we continue to go in that direction. Mm-hmm. There's a lot of good signs, even though there's some uncertainty, and that's pretty typical. It's always kind of a mixed bag, but we're fairly optimistic here, and so I think hopefully the good things continue to develop, and obviously markets will recover if we continue to get better news.
Mm-hmm. And I think you hit the nail on the head when you said it. It's a mixed bag of information. Mm-hmm. And I think right now we're seeing that really showcase itself in the markets, given that GDP's down but jobs are significantly up, inflation's running really hot. So there's a lot of signals that are pointing in different directions.
Right.
And so I think that's an important note, that when we're looking at portfolio management, you're looking at your own investments, it's really important and key to not get too bogged down on one piece of data.
Exactly.
Whether it's GDP or inflation or jobs or anything, even month performance, year performance. There's just so many different inputs going into the market and into the economy that you have to use all of the information to just best position yourself during these times.
Right.
And not overreact to any one bit of news, because as we've seen over the last couple of months, that good news can sometimes result in poor market performance. Right. And sometimes bad news results in good market performance. And they're not always directly correlated in the ways at least we would think at the time. Sometimes it takes months or years to look back and really understand what was truly happening that caused certain price fluctuations.
Right, exactly. So we're continuing to monitor the economy, GDP, markets, and I think there's a misconception out there that oftentimes because the way we invest is not reactive to mm-hmm. what's going on, that we're not paying attention. We are paying attention. We're digesting all that information. We're trying to kind of decipher it and present it to you all out there. And we are very much aware if there's ever something out there that would cause us to make a move in your portfolio, we would. But again, most of the historical data and the way we do things would say, the plan has to be designed to the individual client needs and not what the unemployment number is. So, mm-hmm. but we are analyzing, and we like to, we know our clients and people out there like to stay informed. So we'll keep doing these market updates and giving you guys our thoughts and what's going on in the world and the markets.
Yeah. So if you have any questions, or if there's something on this video that maybe stirred some thoughts in your mind, and you want to run those by us, we're happy to field those calls and emails, and help you feel a little bit more secure about what's going on, and maybe have a discussion about whether or not your risk profile is really in the right spot. So please reach out to us. We're always here for you.
Yep. All right. Sounds good. We'll see you guys on the next video.